Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Tuesday, the 3rd of October, and this is our monthly market monologue where we'll talk about both the stock market and some of the economic data that we see. But before we dive in, we want to remind you, if you have been a client of ours for a while and you had accounts at TD Ameritrade, please remember that this month you will get 2 statements for every account that you had. One statement will be from TD Ameritrade, which should show a zero balance, and then you'll get a follow-up statement from Charles Schwab showing you all of the details of your account, just like normal. So again, if you've been a client of ours, if you had accounts at TD Ameritrade, this month of October, you will receive 2 statements. That said, let's go ahead and dive in. So now that September is behind us, so is the 3rd quarter. So we want to start today by looking at the most recent GDP forecast from the Atlanta Federal Reserve via their GDP Now tool. And you can see on the screen that the last update that they had was Friday, September 29th, and they are forecasting that the 3rd quarter GDP for the U.S. economy will be a positive 4.9%. So how does this translate? So on the screen now we have the histogram showing the GDP going all the way back to 1996, broken down by quarter. On the right-hand side, we see the 2 consecutive quarters in the 1st quarter and 2nd quarter of 2022 where GDP was negative. That's where we would argue that was a recession per textbook definition. So far, the National Bureau of Economic Research has not declared that to be a recession. But as you know, there has been a loud cry from economists all across the country that we would see a recession this year. So far, that has not happened. And you can see that the last 2 quarters, or the 2nd quarter GDP was just a little bit higher than 1st quarter. Well, if the Atlanta Federal Reserve's GDP Now forecast is correct, that would mean the GDP number and the histogram would end up being printed like that. That is not recessionary, and that is expansionary, which should add fuel to the inflationary fire, which is a concern because the Federal Reserve and the Federal Open Market Committee has already raised interest rates at a fairly aggressive rate. You can see on the screen now that the current Fed funds rate is about 5.3%, and that is equivalent to about the high from the late 2000s. The futures market is forecasting, and Chairman Powell is suggesting that they will raise rates. They will likely raise rates at least one more time, most likely next month, in the month of November. Well, if they continue to raise rates too aggressively, there is certainly the possibility that they're going to actually cause the recession that they have been talking about. The problem, as we would see it, is that the consumers are not the reason we have the inflationary problem that we have, but that's a video for another day. To continue on our theme of some of the concerns that we have in terms of the economy, we show you copper. The price of copper is sometimes referred to as Dr. Copper because copper, as it is said, is a bit of a cliche in the industry that copper has a PhD in economics because the price of copper has a history of going down as we're going into a recession, simply because there are so many industrial uses for copper. Well, on the right-hand side of the screen, you can see this red line that I've added to the chart to show a short-term support level for the price of copper. Well, recently the price of copper has fallen through that. It's not significant just yet, but it is definitely a concern that the price of copper has not started to go back up. Here is another one of our concerns on the economic front. On the screen is housing starts, and from several months ago we talked about this where we had corrected below this trend line. However, it looked like the housing starts was getting back to the trend. Well, that has changed again, and it's not all that surprising with the Federal Reserve increase in the interest rates because obviously that impacts mortgages. So this is not surprising, but this is such a big section of the economy that this is also a concern. Now we're going to transition and talk a little bit about the stock market, and we would argue that the stock market is the best leading economic indicator and one of our biggest concerns. If you watched the video from last week, and obviously if you haven't, we would encourage you to go back and do so, you will know that one of the things that we are looking at is certain levels on the S&P 500. So on the screen right now is SPY, which is one of the ETFs that mirrors the S&P 500. And you'll recall from that video on Thursday that we said it is very common for us to expect to test this 4,200 level, which is right in this area right here, which is also where this black line, which represents the 200-day moving average. It would be very, very common for us to test this level. Why? Because this level was so important as we are coming out of a clear bear market. It is very natural from a historical standpoint for us to go back and test that level. We broke out of that level in June, I think it was June 2nd, but we haven't really gone back to test it. Well, that's beginning to happen. And one of the things that we've been looking at is this level right in here. This green dotted line here, this is an anchored volume weighted average price. I won't get into the specifics of it, but it would not surprise us if this ends up being the support, not the 200-day moving average, which would certainly be fine by us. And if you look at the price action, you can see that one of the days last week, we actually touched that volume weighted average price, this green line, and we kind of rallied. Well, then the market has come back in. Yesterday was not really a good day. And this most recent candle is actually today's action. I took this picture shortly after the stock market opened on Tuesday, the 3rd of October. So again, going back to the video from last Thursday, we have not violated the areas that we talked about in that video. So far, we are okay when you look at the big picture as measured by the S&P 500. However, one of the things that we really want to talk about today is the fact that we are not yet in a bull market. We're clearly coming out of a bear market, and this market has been up as defined by the S&P 500, but it is not yet really a bull market. And I want to define what we mean by that, and we'll start by looking at the equal weight S&P 500. So on the screen right now is the equal weight S&P 500 as measured by the ETF RSP. Again, the S&P 500, as you are used to seeing it, is cap weighted. That means the biggest stocks in the index have an oversized influence in terms of how that index performs. The equal weight, it's the same stocks, but now they are giving every stock in that 500 list the same influence on how the index is actually calculated. And you can see here that we are below this 200-day moving average, and it's getting weaker. The bad news is from yesterday's action from Monday, October 2nd, you can see that we had a down day, very down day, and it looks a lot different than what happened on the S&P 500. So let's go back and look at the S&P 500 as measured by SPY. Look at that second to last candle, the one right here. It looks like it's open, it's a positive candle. Down a little bit from Friday, but still traded above where it started the day. But if you look at yesterday's candle on the RSP, the equal weight version, that is not what happened in the average stock. The average stock traded down, and we actually violated these lows from the prior week. Not a good sign. Furthermore, today we opened even lower in the equal weight version of this. So this is one of the reasons why we would say this is not a bull market yet. Not yet. We still think there's reason, and we're going to end on a positive note, so stay with us. But we still believe there's a good chance that we will have seasonal winds at our back. But this is one of the reasons why we are very, very cautious in our allocations, because we are not yet really in a bull market. And let's talk a little bit more about what we mean by that. Now on the screen, we have IWV in this top pane. IWV is the iShares Russell 3000 ETF. So again, the S&P 500, I think there's technically 506 stocks in the S&P 500, but it's only about 500. versus the Russell 3000, it is capturing about 95% of the United States stock market. And so that is one of the things that we are going to look at, is not just the S&P 500. We want to look at what's happening underneath the hood. That's going to help us determine how safe is it to take risk in a client portfolio. So IWV is a Russell 3000. That's the top pane. These bottom three panes are showing the percent above the 20-day moving average, the 50-day moving average, and the 200-day moving average. In other words, what percentage of the IWV constituents are trading above the 20-day moving average? You can see it is less than 11% as of yesterday's close. What percentage of the Russell 3000 is trading above this is really the 2-month average. The 50-day moving average is approximately 2 months in the stock market year. Well, you can see again, 12%. That is a very weak number. However, the 200-day moving average is what we're really going to spend time talking about. The 200-day moving average, if you've been watching our channel or listening to us for any length of time, you know that the 200-day moving average is generally considered the demarcation between whether a stock or an index is trading in an uptrend or a downtrend. So if something is below the 200-day moving average, it is generally considered to be in a downtrend. If it's above the 200-day moving average, it is generally considered to be in an uptrend. So what percentage of the Russell 3000 are trading above the 200-day moving average? As of yesterday, at the close, less than 38%. That is not a healthy market. So what we're going to do now is we're going to zero in on that. This is the same chart. All I did is I just removed the 50-day and the 20-day so that we can really focus on the 200-day moving average, because that is what we're going to use to help us determine whether or not this is really a bull market or not. And you can see on the screen that 2022 started over here, and we spent a lot of time where the average stock is below the 200-day moving average. And so this black line, if I didn't mention this already, this black line represents 50%. So the majority of 2022, more than half of the stocks in the Russell 3000 were below their 200-day moving average. And you can see as the year closed and as this year started, we started to get some traction, but then we dipped back below this 50% mark. And then we came back. Well, again, right now we are in a downtrend in terms of the percentage of stocks that are in an uptrend. So the question is that we had after Friday's video or Thursday's video, one of our viewers sent in a question saying, well, if you say this is not a bull market yet, what is? Well, let us show you what we would say is a bull market. This is a strong bull. On the top of the screen, you can see the timeline. This is the grayed out version. That's what's on the screen. You can also see at the bottom, you can see bottom left, we see this starts in 2012. And we're going to go into September of 2014. This black line, again, is the 50% marker. So what percent of the Russell 3000 is trading above the 200-day moving average? Well, you can see during this entire time period, more than half of the stocks are trading in an uptrend. That is a healthy bull market where we have the majority of stocks in an uptrend. And you can see that at certain points, we're at 90%. That is a strong bull market. Let's show you another one. Now we're showing the late ends of 2015, 2016 starts right here, and then into 2017 all the way through November is just what's on the screen. Again, on the left-hand side, you see that more than half of the stocks are in a downtrend, and the IWV, the Russell 3000, is actually below its moving averages. But as the market came back up, look what happened. This is the 50% line again, and so we see the majority of stocks for this duration, the majority of stocks are trading above the 200-day moving average. That is a strong bull market. We'll show you one more. This is 2020. You see on the left-hand side, 2020. This is the COVID correction, and you can see what ended up happening. Once we got into July, late summer, the majority of stocks were in an uptrend. That is a healthy bull market. Here's another example of why this is not a healthy bull market yet. We're not saying we're in a bear market, but we're saying this is not an easy environment for anybody to be invested in, because it is not a bull market where the majority of stocks are actually participating. On the screen right now, we have the equal weight sector ETFs. And so you have RSP right here. That is the equal weight S&P 500. We already talked about that. Then all of the other tickers here represent one of the main sectors in the S&P 500. And you see this red line is demarking the zero line. Everything below this line is negative year to date. There's only a handful of sectors that are a positive in an equal weight version that are for the year to date. So the technology sector is the clear winner. And you can also see that there's only 2 equal weight sectors that are above the 200-day moving average. The technology sector again, and then energy. So this is a very weak environment. Now, on the screen right now is the equal weight utility sector. So this is taken at the end of the day on Monday, October 2nd. This is utilities. This is widely referred to as a defensive sector. And look what happened yesterday. The utilities environment really had a bad day. We are well below this 200-day moving average. This is not a healthy environment. And then we're going to look at, this is KRE. This is one of our other concerns. However, we're also going to start to transition into the good news, and we will land the plane for the day. So on the left-hand side of the screen, this is when we had the Silicon Valley Bank collapse. And we had several other banks that followed suit. And obviously the concern throughout the economy was that we are going to have a contagious environment where we had Silicon Valley Bank fail, and it's going to lead to all of these other banks failing. That so far has not happened. But the banking sector ETF, KRE, has not really been able to recover. It did put in a low early in May. It started to recover and it came close to getting it back into an uptrend, but it has not been able to do that. Here's the good news on the chart. Monday, October 2nd was an overall pretty rough day for the overall market. But if you look closely, KRE was able to hold its short-term support. If that can hold, that is indeed a good sign. I believe the financial sector is about, I think it's the 3rd largest sector of the S&P 500. This chart was in the video from last week. This is our seasonality chart showing you the average performance for the S&P 500 broken down by month. And we showed you that September is clearly the winner in terms of the worst month in the stock market year, as denoted by the red bar. But September 2023 was far worse than the average September. The good news is that October, November, December, and then January represents the 4 best months in the stock market year. So there is a significant chance, based upon seasonality trends in history, there is a significant chance that we will have the wins at our back as we close out the year. Obviously, the next several days are going to be important as to whether or not we keep those levels that we've been talking about. But we also want to dive in one more level, and this is the seasonality chart for the month of October. And you can see that on average since 1950, every day in the month of October tends to be positive. That's good news, but it obviously doesn't guarantee anything because it's saying October 2nd is on average positive, and yesterday certainly was not. So we'll land the plane here. The summary is that we definitely have some concerns on the economy, and if the broad indices fail to hold those levels that we've been talking about, then we would likely begin to change our forecast as to whether or not we're going to see a recession, because in our view, the stock market is one of the best leading economic indicators. If we can hold those levels where we've been discussing, that is actually good news because we want to test that 4,200 level. If the stock market can pass that test as measured by the S&P 500, then we should have the seasonally strong period of October, November, December, and then January at our backs. And that might kindle the fire, if you will, of all of these other stocks. So we might very well be going through a process that we need to go through in order to have a really strong 2024. That remains to be seen. We certainly hope that is true, but we will run it day by day. As you know, if you're a client of ours, we manage money actively. We're not making forecasts. One of our cliches that we like to say here in the office is we don't predict, we prepare. So we're prepared if we are in a strong bull market. We are prepared if we are in a strong bear market as well. So if you have any questions, if there's anything that we can do for you, by all means, feel free to reach out to us. You can reach us at hicks-associates.com. And if you haven't subscribed already, we certainly hope you will do that. And thank you for watching.